Welcome back, and you're watching Closing Trades here on ET Now. I'm Harsh Saita. Let's quickly have a look at what markets are up to. And 0.5% lower on the Nifty 50 index, the Nifty mid cap as well as small cap under some bit of pressure. 1% lower on the Nifty small cap index. In fact, when you're looking at the intraday trade on the Nifty small cap, on the Nifty mid cap, you're seeing a bit of recovery, but the Nifty small cap is looking extraordinarily weak. 1.5% lower on the Nifty small cap index. When you're looking at the Nifty 500 basket though, we're seeing the breadth obviously negative, and that is one of the reasons why we're seeing the kind of pressure that we're seeing today. The Nifty 50 also seeing a weak breadth. In fact, the Nifty 500 breadth has 350 declines to just about 150 advances, and that's what's really standing out. The Nifty 50 index also seeing some bit of pressure in terms of breadth. 35 declines to just about 15 advances that we're seeing in trade today. In terms of the top gainers on the Nifty, there is Trent, of course, on the back of numbers, ONGC, Tata Steel and DRL. All of them are gaining over 0.5% except Trent, which is up 2% in trade. What's not doing well, a bunch of stocks. Eternal is down nearly 3%. Hindalco down 2.5+%. Kotak, Bharti, BEL, Interglobe, all down over 1.5% in trade. So that's broadly where the pressure is coming from, at least on the index. Let's switch focus to contributors, and far and few in terms of positive contributors, but the negatives. IT, neither positive nor negative in terms of top points contributions on the Nifty, and that is a bit of a breather for the Nifty IT index, but the Nifty IT index nonetheless is down 0.5% in trade. Eclipsed, of course, by the Nifty India Defense Index down over 2%, Nifty Metal down over 1%, Nifty Realty down nearly 1%, and you've also got some other key losers. In fact, all sectors trading in the red except pharma, which is clinging on to green somehow, and the Nifty PSU Bank, which is up around 1/3% thereabouts. So those two are the pockets where there is some hint of green, if at all there is any at this point. Outside of that, all sectors all sitting in the red, and that's how the pressure is building up. It's quite secular in terms of the pressure. Rabinder here though, with all of the stocks on his radar this afternoon to start off this show. Rabinder, what do you have on your list?
Well, as on the back of strong set of number in Q3 FY26, Uno Minda is in focus. The company reported a revenue at rupees 5,018 crore with an uptick of approximately 20% year-on-year basis, and company's EBITDA margin has expanded from 10.9% to 11%. And apart from this, board has also approved capex of 764 crore. So, back of this strong set of number, Uno Minda is in focus. Force Motor, another stock that is in buzzing on the back of the quarterly result, where in Q3 FY26 company's revenue was up more than 12% year-on-year basis at rupees 2,128 crore, and EBITDA margin has expanded from 12.3% to 17.6%. Marico is also in focus on the back of their acquisition, where the company will acquire a 60% stake in digital first functional wellness brand Cosmix for rupees 226 crore, and this marks a strategic expansion in the high-growth plant-based protein and premium nutrition sector. Cummins India is also in focus, where the stock has recovered 7 to 8% from the day's low on the back of the positive management commentary, where management believe that the data center pipeline is strong in India, and next 3 to 4 years is a positive momentum for the data center side. And they have given a guidance of for the FY20. They believe that the FY26 domestic growth will be in the double digits. So, back of this positive commentary, Cummins India is also in focus. And lastly, Hindustan Aeronautics is under pressure, where Morgan Stanley has downgraded the stock to underweight from the equal weight rating and cut target price to rupees 3,355 as compared to earlier target price rupees 5,092. So, back of this, HAL is also in focus.
Thank you so much for that, Ravinder. HAL, of course, that's a big one, and taking another knock of 4% in trade today. But the big brokerage call of the day was Devyani International this morning, and it's in focus because Elara upgraded the stock to a buy, citing a 24% stock correction, steady margins, aggressive KFC expansion, and a better risk reward now. Snehi here with all of the details on that one, along with it. And this is the second straight day of gains for a Devyani. Talk to us about what that note says, Snehi.
Well, yes, so Devyani International and Focus on the back of good set of earnings yesterday, and now you have an upgrade coming in from Elara. They've upgraded the stock to a buy rating from an accumulate, but they have cut the target price to 165 from 185 earlier. But this still poses a 34% upside to where the stock closed yesterday. They say that the stock price has corrected 24% in the past 3 months, and now would be a good time to look at the stock. The reduced target price has been done to factor the downgrade in revenue estimates by 1 to 2% and downgrade in EBITDA estimates by 4 to 8% over FY25 to 28. They say that Devyani sustained positive same-store sales growth in January with margin improvement and a 24% correction in the stock price, and that has improved the risk-reward profile for the stock. So Q3 for Devyani, according to Elara, margins have been in line, but revenue growth has been slightly ahead of expectations. They believe that Devyani has identified key turnaround levers like technology, rationalization of loss-making stores, advertising and promotion expenses, and menu innovations, and these turnarounds could aid the stock going ahead. They believe that the strategic interventions at the Pizza Hut level, expansion of KFC and the same-store sales growth improvement are near-term growth drivers for KFC, for Devyani. And they also say that KFC plans to add about 110 to 120 stores annually. On the back of this, they're expecting the same-store sales growth to drop by 1.5% in FY26 and store count to reach 1,026 by FY28. Lastly, they say that the same-store sales growth of Pizza Hut is expected to decline 5.5% in FY26 and grow up to 2% by FY28. So that's a positive trajectory that they are indicating over there as well. And lastly, they say that quarters ahead should be good because the worst for QSR seems to have peaked and passed in January. So that's the outlook coming in from Elara on Devyani, an upgrade coming in rating, but a slight trim in the stock price target.
Okay, thank you so much for that, Snehi. Now, we also caught up, in fact, with Jignanshu Gaur, Director and Senior Research Analyst at Bernstein, to understand his take on the QSR industry as a whole and the growth ahead for the sector, whether it's at an inflection point. Listening to what he had to say.
QSRs are an interesting play today. They need discretionary demand to come back. I think across all the four firms over the last 2 years, they have made a lot of effort on menu innovation, on reducing the cost structure at their stores to leverage margins once sort of demand comes back. But they are now, I think, at a situation where incremental efforts from them are dilutive in terms of impact. So they need the broad-based consumption scenario to improve. And that the commentary from yesterday from Devyani and Westlife indicates that January is better, but whether that better will sustain over the full quarter or not is unknown yet. And the growth has been very, very, very disappointing across the entire sector, right, for the couple of years, barring Jubilant, of course. So I think the expectation from Jubilant is different, and the expectation from the rest of the pack is sort of different over this year.
Okay, all right. So that's, of course, with regard to Devyani. And we're seeing that move on the stock price within the QSR basket as well. So you've got some of those stocks in focus. Let's also look at within the Nifty 50. How are things playing out? When you're looking at Trent, for example, the stock is up 2%. Is probably the only big gainer within the Nifty. So you're clearly starting to see pressure creep through with regard to the Nifty index. And and outside of Trent, there are just very few heavyweights really sitting in the green. And SBI, for example, is up 0.5% odd. JSW Steel, very, very mild gains. And therefore, you're not seeing any major movers within the Nifty heavyweights, which can actually have an impact on the index, and which is why you're seeing the kind of pressure on the index that you are at this point. But let's go across. We have JSW Cement as well. It's jumped 8%. Strong Q3 numbers. EBITDA surged over 90% with margin gains from operating leverage and cost efficiencies. The company also approved a $39 million capex and plans to double grinding capacity by 2028. Ashesha joins in with the highlights.
Well, yes, so the stock is up 8% and the company has reported very solid volume growth in the quarter gone by, and that clearly aided numbers for JSW Cement in the quarter gone by. Revenue is up a solid 13% on a year-on-year basis. EBITDA per ton, meanwhile, has seen an increase of a whopping 68% on a year-on-year basis. And of course, this is much ahead of what the street was working with. Steady volume growth on account of higher demand from across markets aided numbers for the company going in the third quarter. EBITDA per ton, however, has declined on a sequential basis, and this is on account of soft cement prices in the third quarter on a sequential basis, and that is what weighed heavy on margins QOQ. But YOY margins have been very strong for JSW Cement. Now their capacity expansion plan continues to remain on track. They are looking to expand their capacity and in fact double their capacity by calendar year 2028. Now remember, management commentary from the con call that happened at 10 a.m. today also is very positive. They say that the demand environment is very strong and demand environment is expected to remain strong throughout the fourth quarter. As far as pricing trends are concerned, management said that prices have started slowly picking up and they are expecting fourth quarter prices to remain steady or rise marginally. So yes, management outlook with respect to cement pricing, which has been a concern for the industry, is now starting to improve. And results were also very positive. Capacity expansion plans are also on track, and that is the reason the stock has spiked up nearly 8% in trade today.
Okay, thank you so much for that, Ashesha, with regard to JSW Cement. What we'll do is slip into a very short break. On the other side, we'll speak with Abhay Agarwal. And he's founder and fund manager, of course, at Piper Serica. On the other side of this very short break. Plenty to chat about. Stay with us. And we're joined by Abhay Agarwal, founder and fund manager at Piper Serica this afternoon. Abhay, welcome. Let me first start off by understanding how you're seeing the setup at this point. In terms of the volatility, of course, it's gone up. But talk to us about valuations and how you're seeing the Nifty and whether earnings pick up significantly post Q3, because Q3 suffered from a couple of one-offs, including the labor code adjustments, which most companies have made. Does Q4 really be meaningfully better, in your opinion?
Yeah, hi, Harsh. So I think you're absolutely right. I think this week has been quite volatile starting from Sunday. But I think the market has digested the good and the bad and now is looking for the next set of triggers, which would be the earnings, because I think the valuations, if you look at it after the sideways consolidation over the last year, especially in the mid and small caps, have come now to the fair range. So I don't think anybody would call the Indian markets, whether it's the small caps or mid caps or large caps, as overvalued market. I think once you start building growth into the earnings, I think we are fairly reasonably valued. I don't think the worry with domestic investors or foreign investors is that the markets are overvalued. So I think it's now a market that is ripe for a break on the upside, subject to liquidity flows. And I think the primary candidate for that liquidity flow is the FPIs, which have been constantly selling over the last 13-14 months. So what we are seeing is an early stage of reversal of that flows, especially driven by the correction in the US markets, the tech market, the NASDAQ especially. And I think that is required for the emerging markets to get more flows and the Indian market to get big flows. I think the trade deal has been a very positive sentiment boosting event, because a lot of people had just given up on a trade deal. So I think it's a very pleasant surprise, shows that the government has full intention, and I think it's a great signal to the international and investor community that the government means business and it will get a fair deal done wherever it can. So I think there will be days like today that you will see some selling into that, some profit booking. But overall, I stay pretty constructive on the Indian markets. I think the Q4 earnings will be better than Q1, Q2 and Q3, because what we are finding from our channel checks is very robust demand at the consumption level, at the services level. So I think as far as the Indian domestic consumption market is concerned, very robust. Rupee has kind of found its range. The macros are very stable. Interest rates are under control. So I think my personal view is that we are gearing up for a rally driven by FPI flows.
Very interesting. So if FPIs do come back, Abhay, what are the sectors, pockets which look good? Banking, financials, IT, you go back to the traditional ones, and IT, there's obviously plenty of debate happening there. I'll come to that in the next question that I ask you. But is it the traditional sectors? Is there something new in terms of opportunity that that FIs will hunt for?
I think it's going to be a mix, Harsh, as it always is. We have seen that there are FPIs that like to stick to traditional stories which are still growing. But one thing is very clear, whether it is new or traditional, growth sectors, growth companies will be the primary beneficiaries of these flows, because FPIs are looking to make money from India's growth story. And that is why the focus will be on growth. Sectors that have corrected but are not growing will not find any favor, is my belief. So banking, financial services, definitely, I think, is the sector that has again seen correction, valuation correction. And when you say financial services, it's a broad spectrum. It's just not the lenders. It's much more than that. So I think as India's GDP grows, the whole financial sector, lenders, non-lenders, will continue to do well, continue to grow. So I think that will get a lot of capital. I think pharma this time will look very interesting, because there are young companies that are now coming up. Some of the results have been absolutely amazing. So I think pharma is another sector. The third, I would say, is domestic consumption driven autos and auto ancillaries. Especially, I think a lot of our auto ancillaries have now become global level players, and they are going to start throwing their weight around in next 3 or 4 years. So I think these are the 3 or 4 sectors I think you will see flows coming back to.
Okay. And Abhay, where do you sit with regard to the IT versus AI debate? Is it going to be IT companies coming out trumps in this new AI world, or will it be dilutive to Indian IT in terms of an impact?
Harsh, we have been very, very negative on the Indian large cap IT services companies for the last 4 years. We haven't had any IT services stock in our model portfolio. And the reason is what is playing out right now. There's been a complete lack of growth for the last 3-4 years. The guidance is also pretty poor. Margins have been under pressure. And the primary reason for that is nothing to do with the global demand. It is only to do with the time and material billing model that these companies haven't been able to switch out of. So it's still the model that requires them to hire a lot of freshers at 4-5 lakh rupee average entry salary, and then bill them at a rate that gives them a 20% plus EBIT margin. And I think that model has completely outlived its utility, and now these companies face a very serious threat from the AI companies, and they faced this threat last year from SaaS companies and could not do anything, and now it is even more potent threat from AI companies, and AI companies are now disrupting SaaS companies. So I think Indian IT services companies have fallen far behind this technology curve. They have been busy giving money back to shareholders in form of buybacks instead of investing in innovation, investing in new technology. So quite disappointing overall, Harsh. I don't think anything is going to change that. I don't think these are growth stories. So investors need to be very careful and not look to, bottom fish or bargain hunt in this space.
How should you play the AI theme if you're an Indian investor, Abhay? How are you playing it? Is it through data centers, or do you believe that will largely become commoditized eventually? And therefore, how should one play the innovation part of the theme?
No, I think there are data center definitely, Harsh. I think that's going to be a humongous demand in India, and I think compliments to the finance minister for taking that head on in the budget and incentivizing foreign players also to set up data centers in India. I think that's going to be as big an infrastructure story as our airports and roads are. So data centers are going to be right primary center. But again, data centers have a margin restriction because it turns out to be in some form or fashion a real estate play. So where is real innovation taking place? I think again, I don't think India will have a pure play AI company. There are a lot of companies in the startup space. We have a venture capital fund that invests in AI companies. So we are seeing a lot of opportunities there, but these are young companies. I think in the listed space, investors will have to focus on companies that are using AI as an internal tool to boost their processes, cut their costs, become more competitive, get better controls. So we are seeing that happen in financial services. Large banks have started using AI tools. There are FMCG companies, companies that are new age companies that many of them listed recently are using AI as internal tools. So I think this will become a big checklist item for our investors going forward, that the companies that they are investing in, how innovative they are as far as using AI tools is concerned.
And Abhay, how should one look at the India-US trade deal of sorts? Of course, the fine print is still not completely out, so we don't have a clear signal as to how much has India given up for this trade deal, because it will have to be that way. But this 18% rate, how do you play that theme? Do you play it through textiles, or have the stocks really run up? Therefore, how should one play it? Is it through pharma maybe? I know you're positive with regard to pharma. So is pharma the other way to play it? Chemical, pharma, generics and the like?
Yeah, I think many opportunities. I think textile is obviously, that comes to mind because a traditional large sector. But if you look at the emerging sectors, pharma, especially the CDMO companies, generic companies also that will benefit now. A lot of companies now in India are moving beyond just being generic companies. They have done 150, 200 ANDA filings in the US. So there's a lot of innovation involved there. They will benefit. I think our auto ancillaries will be a big beneficiary. A lot of them have built sales presence in the US. And for last quarter or so, they were struggling with the US tariffs. The order book was a little weak, but now that will clear up. I think in any trade deal, Harsh, there is always going to be some give and take. So as you said, we don't know the fine print, but I'm not expecting any big negative surprise there. I think it will be a fair deal. And as I said, the most important thing is the signaling is very positive, that India is not going to just back off or not work on it, is going to engage. And I think it's a positive sign for US investors. A lot of them were worried that in case a trade deal doesn't get signed, will the US administration become more adversarial and put further sanctions or tariffs on India? So I think that fear is out, and that gives me the confidence to say that, look, the US investors will look at India more favorably now that big risk is off the table.
Abhay, it's always great chatting with you, and especially in a week like this, to try and put everything into perspective. You've articulated it clearly. Stay away from IT. There are various ways to play India-US, and the best way to play it is obviously the fact that FI investors are going to gain a lot of comfort from the way in which they are viewing the deal and the possible relationship post this deal. Thank you so much for coming in and speaking with us. Viewers, what we'll do is we'll slip into a very short break. We'll continue coverage. We'll continue to talk market. We'll have Kunal Bothra coming in, giving us his view with regard to how markets are shaping up this Thursday afternoon. Stay with us.
Back with closing trades right here in 80 now, and just monitoring what the closing trades are looking like just an hour before we wind up for the day, and still lower by about 0.5%. The breadth of the market is well tilted in favor of the declines. While Trent, of course, has managed to hold on to that pole position, near about 4 to 6% move yesterday, and today another 3%. Tata Steel, JSW Steel, some of these stocks have made a comeback. But a large chunk of the market is still in the red. Look at Bharti, it's down about 1.7%. Hindalco, which is lower by about almost 3%. Kotak Bank lower. L&T down 0.5%. Asian Paints and Titan also struggling in trade as we speak. TI India, that's down 10%. MCX is down 5%. In fact, MCX has seen quite a bit of volatility in the last 5 trading sessions alone. Suzlon, Vedanta, Hindustan Zinc, they're all in the red. But on the flip side, if you just look at the liquid universe, look at a Policy Bazaar, that's up 8.5%. The spike, of course, has come in just the last few minutes. Cummins is holding out very well, 5% of an uptick there. Jubilant Foodworks, Nykaa, Uno Minda, these are all companies or stocks which are holding out. In fact, the entire EMS theme has done very well, and we spoke with Saurabh Gupta, CFO at Dixon Technologies, earlier today to try and understand how the sizable component incentive scheme changes their margin outlook, which was announced in the budget, and to try and understand the approval timelines as well for the Vivo JV. Listen in.
We are committing an investment of closer to 2,500-3,000 crores, and we have already got two approvals. Two approvals are in the pipeline. So we feel confident that we should be able to leverage this component PLI scheme to the maximum. We already have a large order book in our mobile business and IT hardware business where we are really focusing on these components. And as far as the PLI is concerned, that's an over and above separate budget. So government is definitely engaging with the industry for its extension. To say for sure that will get extended, it's very difficult, but definitely there have been deep discussions between the government and the industry. And it feels like that the government wants to give more support to the sector till the time the component ecosystem gets evolved or gets created in the country. Yeah, so we expect that the approval should come in soon. We don't see any bottlenecks. Of course, yes, it has been delayed. So very difficult to give you an exact timeline. But we feel that it is just around the corner and we should get the approval soon. And we are in very deep discussions with the government authorities on that particular front. So let's see. But yeah, we feel confident about it.
All right, that's the stock of Dixon Tech. It's recovered from the day's lows, but nonetheless, very, very cautious with regard to the way they've guided, with regard to both the Vivo JV as well as mobile phone production. Kunal, let me come to you. And first, let me take a question on the index itself. What do you make of the market today? It's been a weak day after a couple of decent days of trade, right? In fact, Tuesday was a very, very strong day. Wednesday was a follow-through. Today was expected to be good. Didn't play out quite so. What do you make of the move?
Yeah, I think today's day is where we mirrored what happened across the globe, because most of the global markets, and I think for the first time, because over the last 3-4 months or so, the correlation of sorts was broken or maybe diverged to a certain extent with respect to the global market. So I think it's good to see that our markets are now trying to get aligned with what's happening across the globe. Today, I think was also one of the days where you saw the index coming back to that 25,500 mark, which is a support point. I think over the last, half an hour or so, we've seen a mild bit of a pullback, which has come back again into the indices from those strong support levels of sorts on the Nifty. So I think in that sense, I would probably expect the markets to look a little bit more better. Today, I think what we're seeing is few of the emerging sectors. For example, the Nifty Pharma Index is trying to show signs of recovery. You're seeing the Nifty Pharma Index trading above the 20-day moving average, which I think would be a strong signal that we could be looking at a turnaround of sorts for many of the pharma names. And then the capital goods, names, the likes of Siemens, Cummins, L&T, etc. These stocks have done phenomenally well. And look at the last 1 week to 10 days of charts for many of these names. These stocks have rallied up by a margin of 10% to 15%, which I think is a very strong indication that we are looking at a major revival of sorts for this sector. So I would believe now that we could be at a point where more sectors will start to open up, the market breadth will start to look a little bit more attractive, and dips on the index should be taken as buying opportunities.
That's the stock which is in focus. Remember, it fell nearly 15% since the announcement of its QIP and the international expansion foray. They have cash of about almost 5,000 odd crore rupees on their balance sheet at the end of the first half of the fiscal. But now the announcement that came in that the QIP fundraise has been cancelled. And Harsh, you may want to throw more light on that. I guess the market is only relieved.
Yeah, it seems like it's evident that the market has cheered the fact that PB Fintech will not be doing a QIP. And it would have been a large deal if an acquisition were to come in, because PB Fintech has been holding this 5,000 crore rupees of cash since nearly its IPO. So it's not utilized any of the cash. It's free cash positive now. And therefore, this would have been a business diversification of sorts. Now, PB Fintech is already getting into hospitals. For it to again get into the international segment and how much of that or how much of time would it take to break even? We spoke with the management as well. In fact, we spoke with Yashish Dahiya a couple of days back when this announcement came out on the 3rd of February. In fact, we spoke with him and he said the acquisition will be EPS accretive. But the market was not positive at all with regard to the way and reacted extremely negatively to that acquisition or that announcement. And the stock fell nearly 15% from that point till this afternoon when the announcement came through saying that there won't be a meeting. It's completely cancelled and the QIP2 is now cancelled. That's and markets clearly cheering. Kunal, on charts, this one?
Yeah, in fact, last couple of days we were discussing that how 1450, 1400 levels is a very strong support and a contra buying territory for PP Fintech. So it's good to see that the stock has bounced off from exactly that major support zone. Now I think at current levels we could probably say that the near-term bottom is established for the stock price. I'm not sure whether you probably see a follow-through up move immediately, but I think over the next 1 to 2 weeks there could be a chance that the stock may try and show further up move. My sense is that the stock should come back to at least 1675 to 1700 levels over the near term.
Okay, that's that in PB Fintech. But let's shift focus to the India-US trade deal, and Commerce Minister Piyush Goyal revealed that talks between the two nations are going well. Let's hear out exactly to his soundbite.
It is most appropriate that we now enter into a much stronger and robust trading arrangement which will enable greater free flow of goods, services, bring predictability and stability to policy, help encourage greater degree of investments, and take our bilateral relations between the six-nation GCC group and India to greater heights. We have entered into a record 8 FTAs and will soon announce the 9th bilateral trade agreement's first tranche details with the USA, which has been agreed upon only 2 days back.
Right, so that's that. And let's in fact switch focus. Hexaware Tech has been in focus since the morning. It's been down 7% plus since the morning. You look at the intraday chart, it's been under pressure all the way through the morning into the afternoon. The numbers didn't look particularly good. Ishika here with a breakdown of what those numbers mean and why were they weak. Ishika, give us a sense.
That's right. Hexaware Technologies fell down sharply today, and it was mostly because its profitability saw some pressure. Now the revenue did remain flat, but EBIT as well as EBIT margins have declined considerably along with PAT. Now the reason for this margin compression and this pressure on profitability is that there was a change in the value of contingent considerations, right? And there was also an impact, a great impact from labor code changes. So those are the main reasons. And another thing to note is that there was a major impairment of customer relations associated with a prior acquisition, right? Now this put some pressure on their profitability, and in their con call, Hexaware mentioned that they are expecting a dampener on their revenues going ahead, and they're expecting a weak Q1, which will be followed by better quarters. But this triggered the stock and it fell over 8% today. Back to you.
Hexaware Tech, Kunal, what's the view? Firstly, thank you so much for that, Ishika. But Kunal, what's the view?
See, I think the stock seems to have broken a major support today. So what over the last 2-3 months, we were seeing 640, 660 as a good support for Hexaware Tech. The stock seems to have broken the support today. Also, I think the more concerning part is the 3 consecutive candlestick downtick for Hexaware in the last 3 days. And I think out of those 3 candlestick patterns, you're seeing a major gap down being seen for the stock price today. So that could create some additional pressure on the stock price for Hexaware Tech over the near term. Would not suggest a buy at current levels. In fact, I would probably expect that rallies towards 660, 670 mark could be taken as an opportunity to try and maybe create fresh shorts.
Okay, that's the day coming in on Hexaware. On that note, let's take a very quick break. When we come back, we'll have more experts join in to tell us how the next lap of trading is going to pan out.
In fact, Elara has also upgraded Devyani. But what from a technical side? Couple of days, very good moves. What next?
So there's been a big change which has happened for Devyani in terms of volumes, Harsh, because we've seen many of times price action moves happening for stock prices and volumes being not strong because there is no major follow through for stock prices. But that's the change for the stock in the last 2 days. The volumes yesterday were just about, I think, around 1.5 to 2 crores on the NSE. Today the volumes have clocked in almost 7 crores for the stock price, and that's a steep jump to the average volume prior to that, which was maybe, I think, in the poultry 15 to 20 lakhs odd for the stock on the daily basis. So that tells you that there's been a definite change of buyers' intent from for Devyani International over the short to medium term, and this would have positive effect on the stock price going forward. I would believe that this stock could now become a very good buy at current levels, and in case if it dips down marginally towards say 125 to 130 kind of a zone. On the higher side, I would look out for targets in the range of 150 to even potentially 160 for the stock in the next 1 to 2 months.
Okay, that's the take coming in right now on Devyani International. In the meantime, it's good to see that urban consumption finally, at least the stocks seem to be picking up and materially. Talking about Devyani, look at a Jubilant. That's holding up a sizable 5%. Nykaa is looking good. 260 is where the stock has climbed to. And for the last 2 days, of course, trend has been on quite a steady flow. That stock also higher by 3%. Kunal, Jubilant Foodworks, Nykaa, Trend, what's a good trade?
So I think Nykaa is a far better stock as such. The stock has established itself into a very strong breakout on the medium to long term charts. And remember, there was a point where Nykaa was struggling to break even 200 mid of 2025. But the fact that the stock had now managed to break past about 200 and 250 barriers indicates that we are looking at a new supports for Nykaa over the very short term. The stock is due for a breakout on the higher side. I think 280s thereabout is the previous major high for Nykaa. I believe those levels should be taken out in this leg of uptrend. So even if it's a last 2-3 days of a strong uptrend for the stock price, but I believe 280 is the level of a breakout which one should watch out for Nykaa.
That's that on Nykaa. In the meantime, let's just take stock of earnings and Tata Motors PV, especially after their monthly sales numbers. The street is quite excited about what their earnings are going to actually entail. We are anticipating adjusted losses are expected to narrow down and that EBITDA is expected to turn positive. But Shrishti is here with the finer details on what the street is expecting from Tata Motors.
Well, yes, we all are aware about the issues and the concerns with respect to the Tata Motors and specifically with respect to the JLR cyber attack and the kind of impact that it has made and dented the numbers of the company. Firstly, let's tell you that with respect to the volumes as well, there has been a significant drop because JLR volumes in the quarter gone by did drop by more than 40%, while the India business stood stall with almost 22% of gains, or rather a jump coming in on their overall volumes. With respect to the realizations as well, the India business is expected to perform very well. The margins are expected to improve, but the JLR business, there we are expecting a negative EBIT margin, and add to that, it's expected to be a loss figure that the company is expected to report. Their division at £385 million is what we are expecting for JLR bottom line. Now on to the consolidated front. This time around we are expecting the sequential drop of 3% on their top line. 70,363 crores is what we are penciling in for Tata Motors JLR consolidated numbers. EBITDA is expected at 604 crores, while the consolidated margins are expected at just 1%. But yes, you are right that the losses are expected to narrow down on a sequential basis to 3,277 crores in the loss figure is something that we are penciling in. But what's done is done. We all are aware about the issues with respect to their JLR cyber attack and the dent in the volumes. But quarter 4, the management has been very confident that quarter 4 will be a normalized quarter for JLR. And is that true? Is that something that we are seeing happening? That is something that we will be watching out for keenly with respect to JLR and for the India business. What are their new launch plans, as well as what's the outlook on the margin specifically going ahead for their India entity is something that we will be watching out for. Back to you.
Okay, thank you so much for that, Srishti. Now, Page Industries, that stock has been buzzing. I'll just quickly mark out the numbers because results came out around a few minutes ago. and the stock is up 4% in trade. Revenue is at 1,387 crore, which is up 5%, 6% odd. The expectation was the 1,380 crore number in terms of the top line. You're looking at EBITDA at around 318 crore, which is a 3 to 4% beat, but really profit is where the beat actually came from. Profitability has come in at around 190 crore adjusted. It's come in better than what analysts have penciled in. We'll skip it a very short break, come back, look at this one on charts. Stay with us. Quarters plus. It's the best quarterly top line. And stock, of course, flying away in trade. Your sense, is this rural recovery likely playing out in a more accelerated fashion, and how would you play it?
Most of the consumption sectors have shown better numbers in January. And this is on the back of a reasonably good number in the last quarter. So there does seem to be some kind of a kind of consumption uptick that we are beginning to see. If you look at the auto numbers, for example, they are also showing fairly robust growth year on year. So it would appear that there is a certain increase in the overall demand level. Page has had its own set of challenges over a fairly long period now in terms of managing its distribution, etc. If that has begun to get sorted out, maybe that is also some part of what you're beginning to see. But I haven't looked at the numbers closely enough to be able to give you a considered view on it.
Right, okay. Well, the one space which is picking up, like we were discussing just before the break, Trent, there's Jubilant FoodWorks, there's Nykaa as well, which is holding out. Anand, what's the take now on some of these beaten niche urban consumption plays, if you will, especially if you did take a look at Trent's numbers?
Unfortunately, broadly speaking, the consumption sector still looks fairly, especially the sectors like FMCG and so on, looks fairly expensive even today. Most of the QSR have also reported somewhat middling numbers. There hasn't been much to talk about. If you're looking at things like Trent, obviously, their volumes have been a little tepid for the last couple of quarters. We have to see if the turnaround can be sustained. Again, if you look at the valuations, they may be cheap in relative to their past performance, but that's because the market had bid up most of these kind of companies fairly aggressively on the basis that the growth will be very strong going forward and continue to remain strong. That somehow has not lived up to its promise. So unless we see either the valuations correcting more significantly or the growth becoming more robust, I would still sit on the sidelines as far as some of these more expensive consumption names are concerned. I think there are better consumption plays that one can look at, especially in the consumer durables, etc., where there may be a slight uptick, more likely to be able to be visible in the stock prices in the near term.
You viewing the consumption basket, you look at the likes of a Jubilant FoodWorks on your screen, a Trent also doing fairly well for itself. Any favorites within that pack, and how would you play it? Arpit, this one's for you.
So if we see, very good afternoon to all. If we talk about the chart specific of Trent, so if you look at the bigger trend of the stock has been in downtrend. However, in last couple of days, we have seen some pullback from the lower levels. So if you look at the structure on the weekly setup, it is has given good recovery from the lower levels. But if you see the bigger trend of the structure is still in the downtrend from last almost 6 to 8 weeks. So on the upside, I think the hurdle would be around for Trend would be 4250 levels, 4300 levels. Now, if we talk about overall Jubilant FoodWorks, so Jubilant FoodWorks definitely has been forming in a sideways range from last couple of weeks. And looking at the setup on the weekly time frame, also, if we've seen good recovery from the lower levels. The bigger trend over this counter is still negative, but some pullback can be seen towards 560, 565 levels. So our sense is that Trend and Jubilant Food both would be a reversal play, a pullback move, where we can see 3 to 4% upside move, and the short-term players can trade accordingly and take the positions in this both the stocks accordingly.
Okay, Tata Steel, that's the one also in focus, set to report its numbers. Let me take it across to Ashesha and find out what we can pencil in.
Well, yes, steel major Tata Steel had reported very solid volume growth of 14% on a year-on-year basis in the third quarter for its India operations, and that is likely to aid Tata Steel's consolidated numbers this time around. Remember, realizations are expected to decline, but volume growth is expected to be very strong this time around. On a consolidated basis, we are expecting revenues to remain flat on a sequential basis, but it could rise by about 9% on a year-on-year basis. Tata Steel's margins could come in at about 13.9% for the third quarter. Let's also talk about European operations, because all eyes will be on European operations, which reported a volume decline of about 9% YOY. UK operations continue to report soft set of numbers. In fact, as far as EBITDA per ton for Europe is concerned, that is expected to come in at a loss of $12 per ton versus a profit of $8 per ton that the company had reported in the previous quarter. So Europe is expected to report a loss on the EBITDA level this time around. As far as India operations is concerned, as I mentioned, volume growth was very strong, but steel prices started rising only in the second half of December, and they've of course carried forward in the fourth quarter as well. But in the third quarter, steel prices were on the softer side, and that will likely weigh heavy on realizations for the company. Any kind of management commentary around European operations will be very crucial, especially with respect to their green steel transitioning. But any comments on steel prices and margins in the domestic business will also be very crucial. All in all, higher volume growth is likely to aid Tata Steel's numbers, although realizations are expected to remain soft.
Okay, that's that on Tata Steel right now and what we can expect from the numbers. But Anand, given the volatility and the recent spike of cost that one has seen in metal counters, wanted to understand your take whether there's still value in the table after the run-up in metal names.
Value is a stretch. The domestic steel sector will obviously continue to do well. It is a protected sector with strong import barriers. Unfortunately for Tatas, they have a very large part of their portfolio globally, which is not going to do well, not now, not ever. So I think the domestic steel play may continue to show you fairly robust profit growth. I'm not so sure whether you will continue to get the same spike that you're likely to see in the current quarter going forward, because the prices in the back end will also start to move up, and there will be some pushback in terms of how much prices can move from here on. So I would imagine that you will begin to see some amount of margin pressure going forward.
Right. Okay. Bharti, that's a steady set of numbers is what one is expecting this time around from the telecom major. In fact, let me take it across to Ishika and help us understand what to expect, Ishika, from Bharti's performance.
Bharti Airtel is coming out with its quarter 3 earnings, and here's what the markets are expecting: a revenue growth of around 2.6% sequentially, PAT growth of 5.4% quarter on quarter, EBITDA is expected to be flat, and EBITDA margin as well. A little fall of actually 43 basis points. Now, so overall stable set of numbers are expected in the third quarter, aided by steady momentum across segments. Now, in terms of ARPU, the key metric, it was 255 rupees last quarter. Now, this quarter it is expected to be around 258 rupees. Now, this ARPU growth and subscriber addition of roughly 3 million will be led by 2G to 4G, 5G migration and growing postpaid customers. Furthermore, India wireless subscriber base is also expected to increase. Now, here are the key things that you should track when the results are out: subscriber and ARPU metrics, mobile broadband base, commentary on capex, and as well as commentary on tariffs, competition, as well as regulatory environment. And another thing you should track is the India versus Africa business performance as well. So we're hoping for a quite stable yet robust performance this quarter. Back to you.
Okay, thank you so much for that, Ishika. Now, in terms of earnings, and we're getting them thick and fast. We had the likes of an Uno Binda, a Minda Corp, which came out with numbers. Again, very strong numbers by both of them. Stocks are buzzing. There's also Hero MotoCorp, which will be expected to declare numbers at some point of time today. And what we will be penciling in terms of the top line growth will be the number of around 12,184 crore versus the 10,000 crore odd number that we saw same time last year, 10,260 crore number same time last year. EBITDA is expected at around 1,800 crore versus the 1,415 crore number same time last year. And profit after tax is expected at around the 1,400 crore number versus the roughly similar kind of, or rather 1,100 crore number same time last year. So we're expected to see that uptick with regard to both top line as well as bottom line, disproportionate uptick as margins get better. That is expected from a Hero Moto. Kunal, let me come to you with regard to Hero and Uno Minda, Minda Corp. Would you play auto through Auto Ank? Would you play it through the OEMs like a Hero? And what's looking better on charts in your opinion?
So I think the auto anks so far, I think they're looking a little bit more better in the last 3-4 days of this price action rally, because Uno Minda, you look at Motherson, Samvada Motherson, you look at Sonacom, Star, Sona BLW. I think all of these stocks have done very well for themselves in the last few days. There's been volume price action move which has been very synchronized for these stocks. These stocks have neared breakout for themselves on their respective 50-day moving average. I think, if I'm not wrong, names like Motherson Sumi, for example, has come back towards its multi-week closing high at 110, 112 plus mark. And same is the case with the likes of Sona, BLW, etc. So I think many of these stocks are showing a very synchronized kind of a price action from the auto ank space that looks a little bit more better. If I can probably even maybe club the likes of tire stocks into this space, I think those stocks have also done very well. And after, for example, months of underperformance, names like Balkrishna Industries, that stock has made a very strong comeback in the last few days. Compare this with the traditional auto names, you've seen more or less the auto stocks showing signs of some recovery, but it's been a little tepid as compared to the kind of price action we've seen from the auto ank space. So that's where I would believe that if someone is looking at this as a pure momentum as well as a trading bet, I think auto ank is a much more better basket as of now as compared to the traditional OEMs.
Auto Ank's looking a lot better right now in trade. Just looking at Bharti, that's a little bit under pressure actually ahead of its earnings today. It's sub that 2,000 mark as we speak right now. That, of course, is the take on Bharti. Look at a couple of these technology plays as well. You've got a TCS, which is mildly soft right now in trade. I want to check in on what Infosys and the likes as well are up to. TechM marginally higher. HCL Tech, Hexaware, we were just talking about those counters. And then, of course, Infi, which is lower by about almost 0.5% as we speak right now. Kunal, do you sense that the major chunk of the pain could be behind us when it comes to IT with yesterday's fall, or not quite?
Yeah, I think for select few names, I'm still not sure that the larger cap IT names like of Infosys, etc., they would bottom out very quickly, because the pain could probably be felt in the next few days. But then there are a few stocks which managed to come into deep oversold territories, and they were the ones which saw some good recovery. So as a overall basket, I would still believe that maybe some more time should be given for the overall basket to try and show signs of strength. What happens is, after such kind of a major gap down and then a reversal move, many of these stocks, they tend to see first a sideways price action for the next couple of days, and then see a very gradual kind of a cool off or a price correction further. So we need to wait for at least another week or so to try and establish that maybe the entire basket of the IT stocks have shown signs of bottoming out. But my concentration is only on very few names which have been a lot more stronger. They have been very strong in terms of relative strength on the IT pack, and those are the likes of HCL Tech and Tech Mahindra.
Okay, interesting. That's, of course, the take coming in from Kunal with regard to how he views auto. Curious to know, Anand, how would you play auto and that part of discretionary?
I agree with what Kunal said. I think the numbers from especially the export-oriented suppliers is also looking very strong. And they are catering to not only the domestic play, but the international markets as well. And that has begun to do quite well now. So with that, I think, the ancillaries look like a better place to be, especially those which have a decent or a largish international exposure.
And Anand, what's your take with regard to IT? Actually, Kunal spoke IT. So what's the take on IT?
Well, IT is still a mixed bag. I think if you look at, there are two different trends happening there. The domestic IT hiring has been extremely weak. In fact, if you look at the larger players, there is a negative there, which essentially means that they are still looking at trying to get more out of the people that they already have. And from what I see, you are also looking at getting more mid-level experienced people. So your pyramid is getting distorted. So while on the one hand, you may get better realization for the AI kind of services that you might be willing to give out, and your margins may actually increase because of the fact that you are not hiring so many freshers and having to keep them on the bench. The flip side is that you are also now getting a little more experienced people, therefore your salary levels will be a little higher. On the demand side, I don't see a great uptake even today. So I think you're still looking at, at least the larger companies, at best double-digit, mostly single-digit kind of earnings growth, which with the 20+ PE, I don't see leaving much on the table. I mean, some of the faster-growing ones, which have consistently done well, like Coforge, and perhaps where there may be some upside from here on, maybe things like Tech Mahindra, where the growth rates are likely to be, or at least the analysts are assuming that they will be a little higher going forward than the usual Infosys and TCS.
Just look at JSW Cement. That's one stock. And Arpit, I would want you, to come in over here. The earnings, firstly, on a sequential basis, the top line has come in higher by 13%. EBITDA jump up of about 7% sequentially. EBITDA per ton has seen a staggering 68% of an uptick, but it slipped a little bit on a sequential basis. The commentary from the con call, they're talking about the Jan 26 demand trends, which were much stronger on both demand as well as pricing fronts, and that the management expects a healthy Q4 as well. They're expecting Q4 pricing to be stable to mildly positive, and the non-trade recovery and gradual transmission, according to them, into the trade channel will aid cement prices in Q4 as well. The management, of course, on the sidelines of the con call, has reiterated a focus on executing capex while controlling leverage. Arpit, from the cement plays, what's looking like a good trade to you? And if you're tracking JSW Cement charts?
So if you see overall, the cement space has been a mixed bag. If we particularly talk about JSW Cement, so technically from last almost 8 to 10 weeks, it has been consolidating between 112 to 124 levels, kind of a double bottom pattern on the weekly time frame. And today it has seen a gap up opening. Good part is that it is holding well above 122. That was the previous hurdle zone. So I think from a reversal play, definitely the risk reward is good. If it closes above 120 levels, we can see an uptick towards 128, 132 levels going forward. Along with that, if we see about within the similar space, relatively, if you talk about Ultratech Cement has seen a very good recovery from the lower levels, where the market was overall in downtrend, but Ultratech Cement was holding well. And look at the setup on the weekly and the monthly setup, relatively the base of the stock is shifted higher. On the Ultratech, 12,000 is the new base, major support for this counter, and slowly setting the stock can heads toward 13,500, 14,000 levels positioning. So Ultratech would be a preferred pick within the cement pack going forward, with overall position setup for 13,500, 14,000 plus levels.
Okay, Ultratech clearly the preferred bet within the cement pack. But all eyes come tomorrow will also be on the RBI MPC policy outcome, or rather meet outcome. So let me take it across to Mithali and find out what the street has been penciling in. Mithali?
Right, so the Reserve Bank of India, it is expected to keep the repo rate unchanged at 5.25% according to the poll done by Reuters. The RBI has already cut rates by a cumulative of 125 basis points since February 2025, and economists, they see no immediate action whatsoever for further easing, and with inflation remaining well below their RBI's target. The policy focus, it is likely to shift towards a transmission of the existing measures that the RBI has taken, and RBI's intervention to support the rupee have tightened the system liquidity, limiting the effectiveness of the earlier easing, even as the RBI has injected over $23 billion in liquidity to offset the tight conditions. Growth continues to be driven largely by the government spending, with weaker private capex that has been seen. Also, inflation, it is seen as at 2.1% for FY26, and if you talk about FY27, it is estimated at 4%. Now, the market sentiment, there also some impact has been seen by the capital outflows by the FIIs, where they have withdrawn nearly $4 billion so far. So overall, the upcoming MPC meet, it is going to be expected to reinforce a wait and watch mode, with policy guidance likely to emphasize the more on liquidity management and also transmission of the earlier RBI measures that it has taken.
Okay, thank you so much for that, Mitali. We'll let you go on that note. Kunal, let me come to you with regard to a couple of the cap goods counters. Cummins India up 4%. Even for example, a Timken India is under pressure, in fact, 2% lower. What's the view with regard to cap goods? Good time to play this theme?
I think it's a very good time to play this theme, because names like ABB, Siemens, Cummins, I think all three of these names have showed signs of a very similar kind of a price action move. Again, a very high beta jump for these stocks. You look at ABB, I think the stock was sub 5,000. It's moved up north towards 5,500, 5,600 plus mark. Cummins, I think the stock was struggling at 4,000 levels. That stock has jumped back to 4,400 plus mark. And same is the case with Siemens. So I think many of these stocks have shown signs of a very strong price up move in the last 1 week. There has been a good breakout for these names, 200 moving average breakout, swing breakouts, which you spotted for these stocks. That's a very strong signal that we are looking at a revival of sorts for the entire sector. I would believe that this could be a good space to look out for as a buy at current levels. Don't look at the last, I think, maybe 1 week of price uptrend move, because these stocks have a tendency of starting off strong uptrends with a slight high beta nature and then going into a very steady kind of an uptrend for a prolonged period of time. So I think I would probably look at this as a next 1 to 3 month kind of a major trend emerging for the entire cap goods space.
Okay, that's that on the entire cap goods space. Arpit, if I could just get you in as well, and what's looking like the strongest chart from within cap goods? Does it continue to be L&T or any other?
Absolutely. As we look at the chart of the bigger time frame, so L&T, looking at the chart setup, on the monthly setup, it has given a range breakout after almost 15 to 18 months. And the good part was the last month it retested its previous breakout zone around 3850 levels, and strong rebound was seen from the lower levels. So our sense is that from next 2 to 3 months perspective, positional perspective, definitely the stock can head towards 4,200, 4,400 positionally. So look at the setup wise, this would be a preferred pick with major support around 3850 for an upside move towards 4,200, 4,400 levels. Along with that, Cummins India. So technically, where the broader market has been in pain, the stock has held really well. And similar setup on the monthly scale, retested its previous breakout zone, negation of lower highs after 3 to 4 weeks, a strong bullish candle. So I think definitely Cummins India would be a stock that can definitely head towards 4,800, 5,000 plus levels. So L&T and Cummins India would be a preferred pick within the capital goods space.
And Arpit, let me stick with you. What's the view with regard to HAL? Arpit, that's for you. Your view on HAL, HAL?
So if you see all of the defense stocks, we have seen a very good momentum before the budget. However, if we look the setup on the weekly setup, again, the stock has got stuck in a range between the broader range between 3,800 to 4,700 levels. However, in the last couple of days, we've seen a cool off from higher levels, 4,700 levels. So I think look at the chart setup wise, the stock is still in downward to negative bias. One stock that we look to be on the positive side within the defense space would be Bharat Electronics. So I think Bharat Electronics relatively plays within the entire defense space. A very strong setup on the monthly setup, range breakout after almost 6 to 7 months. So I think going forward, preferably Bharat Electronics is likely to outperform with major support around 420 for an upside move towards 450, 460 levels. HL is relatively underperforming, so it's better to avoid and stick with the overall negative bias for the count.
Anand, defense and HAL in particular, this correction that we've seen, fundamentally, does it look different from what Arpit is seeing technically?
Not a whole lot. I think HAL is a highly expensive and overrated stock with very limited capability of doing anything useful, which has finally been acknowledged by the government when they've allowed them the ECMA should be can be made in the private sector as well, and you don't necessarily have to use HAL. You've had the Air Chief also come out and say that they promise and do not deliver. That is pretty much true for almost all the defense companies, especially mainly in the private sector, in the public sector. And I think to the extent that we are looking at private sector players coming in, that's where the opportunity will lie. Unfortunately, you don't have too many listed direct plays. So they are hidden under companies like Bharat Forge, Mahindra, and so on, where you have to find ways to take, derivative positions. So the valuations don't provide me any great comfort. Not a sector that I would be looking at at this stage.
Okay, that's quite an interesting take there. Anand, Arpit, both of you, thank you so much for your time today. Good to be speaking with you. Let's begin winding up for the day. And it has been a little bit of a volatile ride, although today has been a much narrow band that the Nifty has played in from the high to the low of the day. So what looked like a quiet start picked up a little bit, that got sold in too. And for the better part of today's trading session, we've traded lower, 0.5% down for the Nifty 50. 25,070 is 720 rather is where we're shutting shop for the Nifty futures. The big winners today from within the large caps have been the likes of Trent, Max Healthcare, Tata Steel, JSW Steel, Geo Financials. And on the losing side, it's been about Hindalco, Eternal, BEL, Bharti ahead of its numbers, Titan, ITC, iSure, Axis, L&T and Reliance. So definitely in terms of a weightage or in terms of just the, quality of names, it was the drags which I guess overtakes. On the flip side, within the broader end of the market, where too the breadth of the market has closed in favoring the declines, you had a TI India which was down about 10%, MCX lost about 5%, Vedanta, Hindustan Zinc, Keynes after yesterday's run up, 4.6% lower on that stock, and then it got made up with the Nykaa, Page Industries, Cummins, Jubilant Foodwork, and Policy Bazaar, which were the gainers.
Okay, so those are just some names which came to the fore today. We also had the likes of a HAL, which we just spoke about. But outside of that, in terms of numbers that came out at some point through the day today, there was Page Industries, stock was up 3%. Uno Minda, Minda Corp, both up 2.5% at close. Dredging Corp taking a drubbing, 9.5% lower on the back of numbers. Varroc Engineering, 5.5% lower. Godrej Prop also 1.5% lower on the back of a slightly weaker set of numbers that we saw on the screen. And we saw that come through. Archean Chemicals, despite a very weak set of numbers, closed the day flat. 6% higher on a JSW Cement. That one really stood out. Inventurist Knowledge Solutions also up 5.5%. Force Motors, what a stellar set of numbers, 4.5% higher on that one as well. Cummins and Timken and some of the cap goods names will start declaring numbers, and we saw that. Cummins also was up roughly 4% or so in trade. Broader markets also continue to be under some bit of pressure, 1% low on the Nifty small cap. And we also saw some pressure on the Nifty mid cap, 0.4% lower. The Nifty 50, of course, 0.5% lower as we close the day in trade. Second straight day of losses for the Nifty IT index. Outside of that, the metal counters were also under a bit of pressure. In fact, the metal index down 1% was the second worst performing sectoral index of the day after the Nifty India Defense Index, which was down 2.25% in trade. The only index closing in the green, the Nifty PSU Bank. That one really stood out in trade. Your take for the day, Kunal, and what does this open up for us in terms of levels for tomorrow?
So it repeats the phenomenon of Tuesday and Thursday. For the index, Tuesday expiry is generally a positive.
Today's Thursday.
Yeah, and Thursday is a contra day, which generally happens for Tuesday. With respect to Tuesday, so I think in that sense it's maybe a sort of a effect which is playing out, the Tuesday effect which is playing out on Thursday for the indices. But I'll take the market reading today is a little bit more positive because the market breadth was still a little bit more better, and the new sectors start to show signs of strength. We saw the infra index, we saw the capital good names which start to look a lot more stronger. The VIX is still narrowing, dropping down towards 12.1 mark by the close of the day today. So that's another positive. And I believe that till the time the index holds on to those 25,500 mark on the spot basis, there is going to be a chance that the index trends will continue to build up.
Okay. Kunal, thank you so much for that. We'll let you go on that note. But it's time to wrap up, frankly, this edition of Closing Trades. We've closed for the day 0.5% lower. It'll be good to see as to what plays out in trade tomorrow. But it's not the close of the week yet, and what we're going to do is we're going to get you insights, unique insights, budget discussions, and we're going to do it on ground. ET Now is hosting the India Investment Summit in Mumbai this Friday. Thought leaders, visionaries, policymakers, investors, MSMEs and innovators will unravel the union budget of 2026, analyze its impact and chart the country's economic direction for the next year. The summit puts the spotlight on India's BFSI sector at a pivotal moment between tariffs, currency, valuations, and the implications coming out from the union budget and the forthcoming financial year. Tune in to ET Now India Investment Summit.